speaking of access, let's talk about leverage. This is the third magic wand I wanted to bring up today. This is where cash value life insurance can turn $1 into many without the gut-wrenching ups and downs of market volatility or begging the bank for a loan or getting a margin loan on your brokerage account. Internally, a Bank on Yourself policy has little volatility. In fact, there's guaranteed growth. Every year, you are contractually guaranteed more money this year than you had last year. But you also have liquid access to that money. That means you can grab the cash through a policy loan, and specifically what's known as a non-direct recognition loan. It means your money compounds even when you borrow it as if you had never touched a dime of the money. Now you can leverage that cash, okay? So that means if you've got some cash in your policy, you can leverage it. You can borrow against it to tackle opportunities outside of your policy with a lot less risk. So there's no need to lose money by borrowing from a bank and paying them all this interest. No, you can borrow against your cash value tax-free and say maybe invest in some real estate or business. And then you can repay the loan to the policy on your own terms. It's almost like having a private banking system for yourself. I'm going to give you an example of what I'm talking about. Say you've got 30 grand in your savings account and it's earning zilch, okay? It's earning $0. Put that money possibly into a single premium whole life policy and it'll buy $50,000 to $70,000 in death benefit day one, depending on your age, health, gender, and that sort of thing. But it's obviously going to be bigger than your contribution of 30 grand because it's life insurance. Now, the cash value would be mostly liquid as well. Cash value will grow similarly to a high yield savings account or, a bond fund or something, but with a lot more leverage. If you don't like the idea of a single premium policy and a modified endowment contract, dump the 30 grand you have in savings into the policy's premium deposit fund and it'll drip into your policy over 5 years, 3 years, 7 years, however long you want to fund your policy for. And that means the policy will be funded and it'll have tax-free access to the cash, all in a zero-gain world in the stock market. Or consider a $200,000 that you might have laying around in a CD earning 0.5% or whatever. That's only a couple $100 a year, barely beating inflation. So maybe split that up. Take 100 grand, put it into what's known as a straight life annuity. For you, if you're 65 years old, that'll pay out about 6 grand yearly, guaranteed for the rest of your life. And if you pass away after one payment, the insurer keeps the rest. Yuck. But the other 100 grand that you split up, remember we started with 200 grand. We put 100 into an annuity that pays you a very substantial $6,000 a year. That's double what Wall Street would recommend. We took the other 100 grand, we dropped it into a policy, and the death benefit is $200,000 on the whole life policy. So again, if you only had one payment of 6 grand from the annuity and then pass away, your family would get the $200,000 income tax free back to them. And if you lived for 30 years, the annuity would pay out $180,000 on that 100 grand you put into the annuity. And meanwhile, the life insurance would grow to $300,000 death benefit. Let's back up here. Remember, you started with 200 grand. And you'd get back a grand total, do the math on what I just said there, $480,000, almost essentially and almost completely income tax free. And that would be in a zero rate world where the stock market was flat and interest rates were low. Guys, this is what we call leverage. We're using leverage to your advantage.